Hello everyone. In this particular problem, we are going to work on the final steps in the accounting cycle. Basically what goes on in the accounting cycle, we record our normal recurring journal entries. From there, we're going to post that activity to the ledgers to keep running balances in all the ledger accounts. We will take those running balances in the ledger accounts and prepare what's known as an unadjusted trial balance. From there, we go through an adjustment process, which we typically do at the end of every accounting period. After those adjusting journal entries are recorded and posted to the ledgers, and we have updated ledger balances, we can now prepare what's known as an adjusted trial balance. And that is the starting point in this particular homework problem. We've gone through all of those steps, and we have an adjusted trial balance. From the adjusted trial balance, we can now prepare our financial statements. There are 4 required financial statements, and they need to be prepared in a particular order. The first financial statement that's prepared is called an income statement. So here is our adjusted trial balance, and you can see we have our running balances. Our assets all have debit balances. Our contra asset has a credit balance. And then we have our liabilities. They have credit balances: accounts payable, notes payable, salaries payable, interest payable, and unearned revenue, also known as customer deposits. Okay. Then we have our equity accounts. There are 2 equity accounts: common stock and retained earnings. And then for the year, we also have revenues and expenses. Revenues have a credit balance, and all of our expenses, which we see here, they all have debit balances. Ultimately, these revenues and expenses, we're going to close these balances out to 0, and we're going to suck it up or vacuum it up into the retained earnings account. Think of the retained earnings as the vacuum. It sucks up all the revenue, expenses, and dividends if we had them, but we don't have dividends in this particular example. And so our first requirement is to prepare an income statement. The income statement is the first of 4 required financial statements that need to be prepared. When financial statements are prepared, you can see that we started out with 3 rows. The first row is always the name of the company. The second row is the name of the financial statement. And the third row is for the time period. Now, an income statement has a beginning date and an end date. It's for a period of time from point A to point B. So this is for the year ended December 31st. Okay, and basically if we come back up to the adjusted trial balance, we're going to find everything we need. The revenue is $52,000, and so we list that first. The revenues are $52,000. And now a listing of all of our expenses. Insurance at $6,000, office rent $9,000, supplies $440, salaries $48,000, and the list goes on and on. And you can see these numbers here: $6,000, $9,000, $440, $48,000, and so on and so forth. If we add up all of our expenses, it comes to this number here, $83,240. We're going to subtract that from our revenue to get net income or net loss. In this case, it's a net loss because the expenses outweigh the revenues. Okay, remember this number, net loss, negative $31,240, because that is needed to prepare our second financial statement. Our second financial statement is called a retained earnings statement. Now remember what retained earnings is. Retained earnings is the vacuum. This is the equity account where the red accounts, R-E-D, red, revenues, expenses, and dividends. Basically all these balances get transferred, if you will, to the retained earnings account. So retained earnings statement is simply a roll forward of this retained earnings account from the beginning of the year to the end of the year. Now, retained earnings at the beginning of the year, you're going to find it right in the adjusted trial balance. So here it is. It had a beginning balance of $2,600. So we're going to say, once again, a statement of retained earnings, just like an income statement, it's going to be headed up with 3 rows. The first row is the name of the company. The second row is the name of the statement, in this case the statement of retained earnings. And retained earnings, just like an income statement, is for a period of time. It's got a begin date and an end date. So we're going to say for the year ended December 31. So we're going to start by saying retained earnings at the beginning of the year. And you just saw this number from the adjusted trial balance, $2,600. Now, what did I say? How is retained earnings affected? They will increase with revenues, and they will decrease with expenses, and decrease with dividends. So what is the revenues minus the expenses? Well, we just calculated that back here. You remember? The net loss. This is the revenues minus the expenses, $31,240. Now, if it was a net income, we would say positive amount and add it to the beginning retained earnings, but it wasn't, right? This was a net loss. So the net loss means revenues minus expenses. And the expenses are bigger than the revenues with the net loss. So we're going to subtract this number from the beginning retained earnings. And then we would subtract out dividends. In this example, there are no dividends. I know that because I did not see it on the adjusted trial balance. If there were dividends, we would say less dividends. But we don't have it, so we have retained earnings at the end of the year, which was the beginning number less the net loss. Once again, remember, it would be positive, it would be plus if it was a net income, but it's not. And so we have retained earnings at the end of the year is negative $28,640. Remember this number, negative $28,640, because that is needed to prepare the balance sheet. Now, the balance sheet is the third required financial statement. The balance sheet, unlike the first two that we prepared, which were the income statement and the retained earnings statement, the balance sheet is not for a period of time. The balance sheet is what I like to call the snapshot statement. It's the photograph statement. It's basically, and you all know what a photograph is, it basically is an image that's captured in time. Okay? And that's what a balance sheet is. It basically says, as of close of business, December 31, these are what the running balances looked like at that point in time. So it says, the last row, it doesn't say for the year ended, it just says December 31. It's as of December 31. And basically the balance sheet follows the accounting equation, which is assets equals liabilities plus equity. If we go back up to our adjusted trial balance, we will see these are all the running balances in our asset accounts. Cash is $960, accounts receivable $300, unexpired insurance $2,000, prepaid rent $1,500, supplies are $200, the furniture and fixtures is $8,400, less its contra asset of $5,200, and we're going to show the net amount right here of $3,200. Add up all of our assets, $8,160. And once again, where do these numbers come from? They're coming from right here. All of these numbers that are highlighted are our assets. Now we have liabilities, which are going to be these four numbers right here. We have accounts payable, notes payable, salaries payable, interest payable, and unearned revenue. They make up the liabilities. Here are the numbers. 1, 2, 3, 4, 5. Accounts payable, notes payable, salaries payable, interest payable, and unearned revenue for a total of $32,800. Here they are, 1, 2, 3, 4, 5. Okay. And lastly, our equity section. Equity has two accounts, capital stock and retained earnings. The capital stock, as we see, is $4,000. Okay. Now, what is the retained earnings? Remember, the retained earnings, you can't grab it right from the unadjusted trial balance. We got to take the retained earnings plus the revenues minus the expenses. And when we do that, we get a negative number. It's got a debit balance. Normally, it should have a credit balance. But because it has a debit balance, it's going to be in brackets. Negative $28,640. Do you guys remember this number? That was from the previous retained earnings statement. There it is, negative $28,640. Okay, and we add up our two equity accounts. Total equity is negative $24,640. Add that with your total liabilities of $32,800. We get total liabilities and equity of $8,160. There is a fourth required financial statement, and that is called a cash flow statement, which is simply a listing of all the ins and the outs, the cash inflows and outflows of the cash account from the beginning of the year to the end of the year. Effectively, it's a roll forward of your cash account. We will be studying that in the last chapter in this course. I'm not going to show it to you now, but I do want to make mention so everyone understands there is a fourth required financial statement. Okay, after the financial statements are prepared, the next step in the accounting cycle, there's two more steps in the accounting cycle after we prepare financial statements. And those last two steps are, number one, prepare closing entries, and then number two, prepare an after closing or post-closing trial balance. So what are the closing entries? The closing entries are those journal entries to make the red balances zero. What are the red balances? R, revenues, E, expenses, D, dividends. Now from your studies, you know that revenues have a credit balance. So the question is, how does a credit balance go away? Well, we will take that credit balance and debit it. That will make the balance go away. And we will, on the opposite side of the journal entry, we use this account called income summary, which will be credited. So that's the first closing entry. The second closing entry is to close all the expense accounts. Now, if we think about it, expenses have a debit balance. So how would I make a debit balance go to zero? Well, you have to credit those balances. So here I'm circling it, I'm highlighting it with my cursor, right? Or circling it with my cursor, excuse me. We're crediting all the expense accounts to make them zero balances. The opposite side of the journal entry is this, income summary. So, and then of course we'd have a closing entry to close dividends. Because there are no dividends in this example, we can skip that closing entry. And the last closing entry is to close out income summary. So revenues are all zero, expenses are all zero, but now all of a sudden we've got this debit balance in income summary. What is the debit balance? It's $31,240, which is the difference between the $83,240 debit and the $52,000 credit. The difference is a debit balance of $31,240. So the next closing entry is, how do I get rid of a debit balance in income summary? Well, I will credit it. And the debit goes to retained earnings. Do you guys know what this debit to retained earnings is? This is the net loss. If you go back to the income statement, and I will, there it is. You guys remember? Negative $31,240. That is the net loss. That is the amount that is going to be decreased in retained earnings. That's the net loss. If it was a net income, this would have been flipped, and the income summary would have been debited, and the retained earnings would have been credited. So those are the closing entries. And after the closing entries, the last step in the accounting cycle is to prepare a post-closing or after-closing trial balance. When you take a look at this after-closing trial balance, a couple of things should pop out at you. What is different from the after-closing trial balance as opposed to the adjusted trial balance that we started this problem with? And I'll give you the adjusted trial balance again on the screen. If we take a look, what is different? The difference is from retained earnings downward. Okay. What has happened is with the post-closing trial balance, the retained earnings number has changed, and all of the revenue and expense and dividends accounts are gone. Why? Because the red accounts now have a zero balance. That's why they're not listed here. Where did the balances go? They got sucked up or vacuumed into the retained earnings account. That is why the retained earnings account went from $2,600 credit balance to a $28,640 balance, because all of the revenues and expenses and dividends, if we had them, would have been closed or transferred into the retained earnings account. So that wraps up all of the steps in the accounting cycle. And we saw that in the last 3 chapters. Chapter 3, where we looked at the normal recurring journal entries, and we went through a posting process, and then we prepared an unadjusted trial balance. Chapter 4 is when we went through adjusting journal entries, posted them, and then prepared an adjusted trial balance. And here we are in Chapter 5, dealing with the last steps in the accounting cycle, and that is preparing financial statements, recording and posting closing entries, and then ultimately preparing an after closing or post-closing trial balance, which you see here. Now the accounting is ready for the next accounting period. We're starting with fresh zeros in all of our red accounts, all of our revenue, expense, and dividend accounts. They're starting with fresh zeros, and that's what we want.